Reading and understanding financial statements can be very challenging, especially if you're just starting out on your investing journey. In this 4-part video series, we're going to start off with a brief introduction, then we'll move on and have a look at the income statement, then followed by the balance sheet, finishing up with the cash flow statement. A lot of these key learnings from this video series will be taken from Warren Buffett and the Interpretation of Financial Statements, written by Mary Buffett and David Clark. Let's kick things off with a brief introduction. In the mid-60s, a younger Warren Buffett began to re-examine his mentor Benjamin Graham's investment strategies. And in doing so, he made two stunning revelations about what kind of companies would make the best investments and the most money over the long run. As a direct result of these revelations, he altered the Graham-based value of investment strategy. The purpose of this video series is to explore Warren's two revelations. Number one, how do you identify an exceptional company with a durable competitive advantage? And number two, how do you value a company with a durable competitive advantage? To understand Warren's first great revelation, we need to understand the nature of Wall Street and its major players. In the early 1930s, an enterprising young analyst on Wall Street by the name of Benjamin Graham noticed that the vast majority of hotshot stock pickers at the time on Wall Street didn't care about the long-term economics of the business that they were buying and selling. All they cared about was whether the stock prices over the short run were going up or down. Old Benjamin Graham also noted through these hot stock pickers, while caught up in a speculative frenzy, would sometimes drive up the stock prices to ridiculous levels in relation to the long-term economic realities of the underlying business. He also realized that these same hotshots would sometimes send stocks prices spiraling to insane lows that ignored the business's long-term prospects. It was these insane lows that Graham saw a fantastic opportunity to make money. Graham reasoned that if he brought these oversold businesses at prices below the long-term intrinsic value, eventually the market would acknowledge its mistake and revalue them upward. Once they were revalued upward, he could sell them at a profit. This is the basis of what we know today as value investing. Benjamin Graham was the father of this. Warren learned value investing under Graham at Columbia University in the 1950s. And then right before Graham retired, Buffett actually went to work for Graham at his Wall Street firm. After Graham retired, Buffett returned to Omaha, where he grew up as a child, and he started to ponder some of his mentor's investment strategies. Buffett started to ponder a few of Graham's rules. One of the first things he noticed was a lot of Graham's undervalued businesses never really revalued back upward. Some went into bankruptcy, and with every batch of winners also came quite a few losers, which greatly dampened the overall performance of Graham's portfolio. Graham tried to protect against this scenario by running a very diversified portfolio, sometimes containing up to 100 different companies within the portfolio. Warren decided that he could improve on the performance of his mentor by learning more about the business itself and really drilling down and understanding the financial statements of these companies from the perspective of what made them such fantastic long-term investments. What Warren learned that these fantastic companies, they all had some kind of competitive advantage that created monopoly-like economics, allowing them either to charge more or to sell more of their products. In the process, they made a ton more money than their competitors. Warren also realized that if a company's competitive advantage could be maintained for a long period of time, if it was durable, then the underlying value of that business would continue to increase year after year, making it a great long-term investment. Buffett also discovered that a handful of the companies he and Graham had purchased and then they'd sold under Graham's 50% rule, which was where if a company had returned more than 50%, they would move it on, had actually continued to prosper year after year. In the process, he saw these company stock prices soar far above where they had bought them originally. Let's take a look at an example. In 1973, Warren invested $11 million in the Washington Post Company, a newspaper with a durable competitive advantage at the time. And from that time, 1973 to the year 2008, that 11 million had grown to 1.4 billion. And over that entire period, Buffett had not paid a single cent in tax. Whereas Graham, on the other hand, under his 50% rule, would have sold Washington Post investment back in 1976 for around 16 million and would have paid a capital gains tax of 39% on his profits. Buffett has figured out that these companies with a strong competitive advantage can be broken down into three basic business models. They either sell a unique product or a unique service, or they are the low-cost buyer and seller of a product or service that the public consistently needs. Let's break each one of these down into a little bit more detail. So the first, selling a unique product. Think of this as the world of Coca-Cola, Pepsi, Wrigley, Hershey's, Budweiser, Coors, Kraft, the Washington Post, Procter & Gamble. The list goes on. Warren likes to think of these companies as owning a piece of the consumer's mind. And when a company owns a piece of the consumer's mind, it never has to change its products, which, as we'll find out in later videos, is a very good thing. The second on the list is selling a unique service. This is the world of Moody's Corp, H&R Block, American Express, Wells Fargo. These companies sell services that people need and are willing to pay for. And last on the list is being the low-cost buyer and seller of a product or service that the public has an ongoing need for. This is the world of Walmart, Costco, Nebraska Furniture Mart, Burlington Northern Santa Fe. The key here is to be both the low-cost buyer and also the low-cost seller, which allows you to get your margins higher than your competitors and still be the lowest cost seller of the product or service. Consistency is key. This is what gives companies their durability and their competitive advantage. Let's use Coca-Cola as an example. I know I've been banging on about Coca-Cola a fair bit, but they're a great example of this. So Coca-Cola's been around for 100 years, and there's a pretty good chance that it'll be around for another 100 years unless the world starts phasing out sugar. But let's say consistency is the product that creates consistency in the company's profits. So if the company doesn't have to keep changing its product, like Coke, for example, it won't have to spend millions on research and development each year coming up with new products or new designs. Nor will it have to spend billions like retooling its plant to manufacture next year's model, like a car manufacturer like Toyota or Honda or any other car manufacturer will have to always keep upgrading for next year's models. So the beauty of this is the money just starts piling up year after year, which means that the company doesn't have to carry a lot of debt, which also means that it doesn't have to pay a lot of interest on that debt, which in turn means that it ends up with a lot of money to either expand the business or buy back a lot of stock or even return some of that capital to shareholders in the forms of a dividend. This video was a brief introduction to Warren Buffett and the interpretation of financial statements. In the next video, we're going to break down into detail the income statement and have a look at what actually Warren Buffett looks for on the income statement. If you did enjoy the video, please drop us a like, and if you're new here, please consider hitting that subscribe button. That way you can stay up to date when the next video drops.